Sellers, buyers, calls, puts, all these weird names. What do they mean? Today, we're going to understand what are calls and what are puts. So welcome to the first of many videos for crypto options for dummies. Let's not waste any time and jump right into it. Hey folks, I hope you're doing great. Today, as the title and the introduction says, we are going to be learning and understanding crypto options. We're going to start with this video, and I want to see in the comments down below, what do you want to see regarding options? It can be crypto options or stock options. We're going to make more of these videos to educate you. So what do you want to know? Do you want to know what is a strike? Do you want to know about expiration date? What do you want to know about? Or what is the difficulties that you have today that we can try to help you solve? So leave it in the comments and we can discuss and learn together. That being said, if you're starting with options, you're going to have some difficulties if you come from a futures trading. If you're trading futures, you just have two buttons. You just have a long and a short. Maybe you have a leverage slider, but that's the end of it. You decide how much you want to put. You can go long or you can go short. For options, you have calls and puts. But before we jump into calls and puts, you have to understand that options are derivatives. And the best way to explain this is with two examples. The first one is that options are pretty much a bet between two people. So me and you, we have a bet, and I can be making this bet and you accept the bet. So I'm the writer and you are the buyer of this bet. Another name for bet is option. So I could be the seller of this option. And what is this option about? Well, this is a bet about an underlying asset. In our case, cryptocurrency, Bitcoin, Ethereum, and other altcoins, but mainly Bitcoin and Ethereum. So what is this bet? Well, this bet is that the underlying asset is going to be at a certain price, below or above a certain price, on a date that we decide together. This is called the expiration date. So it is a bet between person A and B regarding where the underlying asset is going to be on that specific date that they mentioned. This bet has a pricing itself. It's called premium. It is how much it is worth right now for the buyer to buy this bet or to bet on this option. So he offers money to the writer itself. This is the premium. It is the cost. And the premium can be volatile as well. So the price of this option can differ day by day. Now, we're not going to get into details because there's a lot of different variables that make the pricing itself of the option, of the premium. But you just need to understand that the price that an option has today is going to be different than a price that it has tomorrow, mainly because of the price of the underlying asset. So if Bitcoin is today at 68,000 and tomorrow Bitcoin is at 70,000, the price itself of this option that me and you are trading is going to change as well because Bitcoin moved during the night. So this option can be two things. It can be a call or it can be a put. This is where things start to get a little bit interesting because a call and a put, they can both be two different types. So you can see how it started as an option and then divided in two, calls and puts. And now these calls and puts, they divide themselves in two as well. You can be buying a call or you can be selling a call. You can be buying a put or you can be selling a put. When should you do each of these? Usually for calls, you are bullish. So for calls, you believe the market's going to go up. For puts is the inverse. So for puts, you believe that the market's going to go down. The underlying asset's going to go down. So calls and puts are similar to long and shorts, but you can sell a call. When do you sell a call? Well, when you are the inverse of bullish. So if you are bearish, you can sell a call. And on the opposite, if you're bullish, you can sell a put. Because again, if you're buying a put, you believe that the market's going to go down. So if you're selling a put, you believe that the market is going to go up. So if I'm selling a put, isn't that the same thing as buying a call? In the ideology, yes, you believe the market's going to go up, but not in P&L, not in how much you can make out of it. Because if you're selling a put, you have a limited maximum profit. And if you're buying a call, you have an unlimited maximum profit. And this applies the same for the opposite. If you're selling a call, it's the same thing in ideology of buying a put. You believe the market's going to go down. But when you sell a call, you have limited upside. And when you buy a put, you have almost unlimited upside. Your maximum profit on this option on buying a put is if Bitcoin goes all the way down to zero. So almost infinite upside. Well, let's visualize this here in Bitopics. Bitopics is where we trade. Bitopics is where we do all of our option related strategies. So on Bitopics, you can see right here, calls and puts. These are for Bitcoin options. You can also switch to Ethereum options right here. Same thing, calls and puts. Right now, and again, this is just right now, this is something that it's going to change really soon, mainly because of an update. If you don't know about the update, we have a video for you to watch right here in the top right corner regarding on how Bitopics will look in just a few weeks. We're working on a very new UI UX for you to be on the best crypto protocol out there. But coming back here, we have calls and puts. But on Bitopics so far, you cannot sell these options. So you can only buy calls, you can only buy puts. But you have another tab, which is the income products tab. Here you have advanced strategies that we simplified just for you. They're pretty much like selling calls or selling puts, but they are advanced strategies. There are what is called spreads. We talked about spreads before. Again, the video will be right here in the top right corner. So check it out after you finish this video if you want to know more about spreads. But we are talking about simple options. So let's go back to them. And here we have three different aspects of an option. I talked about them before, but we're going to repeat them. The series, the strike, and the size. So triple S. Series is for the expiration, when this option, when this agreement between two parties, when it ends. So you can see it goes from April 7th all the way to March 2025. So almost 1 year in the future. What is the strike? The strike is the price that you guys are agreeing on, that it needs to be above or below. So above if it is a call, below if it is a put. Again, it's the price itself of the option when this expires. And the amount is just the size. So if you want one contract, if you want 0.1, because again, on Bitopics, you can sell fractions of a contract. This is useful because for Bitcoin, we're talking about $60, $70, $80,000 per Bitcoin. So the contracts, they get kind of salty as well. The size of them gets very big. So you can reduce the amount of money that you're willing to spend or to invest if we're talking about sizing. So you can size down instead of sizing up. Everything. Okay, but now when should I do something or when should I do something else? Again, if you're starting, I think you should just go for buying options first. So you buy calls, you buy puts, and you understand what it actually means. What do you actually want out of this operation? What do you want out of this trade? So if you are bullish, you're going to buy a call. If you're bearish, you're going to buy a put. This is the overall idea for how to solve this problem. But then once you start to understand how the price moves for this option, how the underlying asset affects the price of this option, then you can start to looking more into the passive income side, which is what we have here in the income products section of Bitopics. And what does it mean? Well, instead of going to the speculation side of the derivatives, you're going to the passive income side of derivatives, which is making consistent recurrent income by selling. So you open these call spreads or put spreads according to what you believe the market will do in the future closer to expiration date. So again, now you kind of understand options. Let's recap. Let's bring back the image again that we made. And what is missing? Well, the expiration. What is the expiration? Is again the final date of this option, of this contract between person A and person B. And usually when you're a little bit more of a degen, it is closer to expiration. It is closer to the current date that you open the position. If you are a little bit more long-term investor, you can go to leaps. We talked about leaps in the last video, and it is options that are long expiration dates, so they go years in the future, like for example the one we saw here on Bitopics, which was 1 year in the future. So your option has 1 year to go in your favor or to go against you, but usually when you do leaps is because you're mostly certain that it's going to make you money, and this is why people trade long-term options, and people trade short-term option to get that quick reward, you know, that quick trade in and out, to make that huge spike, maybe in volatility, maybe it is an announcement or some news that you're trading, then they go for shorter expirations. And to wrap it up, I like to answer a question that I saw here in the YouTube, which is for the seller. When you are a seller, you're usually looking at a very small return on investment on a weekly basis, and a lot of people kind of didn't understand why it makes sense. We went over the POP, which is the probability of profit, and the idea is that in one day we made 4% return on investment, but they said that the bet was not very favorable because you could either make 4% out of this amount of money or just lose 100%. And people say, how is this fair? You're just putting $100 for you to make $4, but if it goes against you, you lose $100. It's going to take a whole lot of other trades for you to make that $100 again just by $4 and $4 and $4. But what people don't understand is that the probability of profit makes it profitable for you to do this. Because again, we're looking at over 90%, sometimes 95, 96, 97% times that you are profitable. We also had someone who commented on that question saying that last year they had only one trade that went against them. So you can see how profitable this is throughout the whole year. So what I like to use as an example for this situation is your car insurance company. Let's say you have a car and let's say you pay $100 to your insurance company. So over 1 year, you paid $1,200 to the insurance company. Well, your car most likely is worth more than $1,200. Most likely it is like $10,000. So why does it make sense for the insurance company to bet $10,000, which is the value of your car, to be making $100 per month? Again, because statistically, it is very unlikely that you're going to be crashing, not only once, but the whole year. But this number is very little. And what does it mean? It means that for them, it makes sense to have this bet because little by little, they're going to be making free money pretty much. They of course have the $10,000 cash for your car if something happens, but because it is very unlikely that something will happen to you, statistically you're not going to have a car crash or not going to have a car accident anytime soon. For them it is very profitable to charge you $100 because for them they're just collecting money, and in case something happens they have the funds to cover that loss. Again, this is pretty much the same that a seller does. I believe that making 4% every week, maybe 3%, maybe 2%, if you go to the compound calculator that we used before, 1% per week throughout the year, we're still looking at over 60% compounded per year, which is a very huge return on investment. So you can see by little, just drip by drip, you're going to make your portfolio size increase by a lot. So just wanted to answer this in this video, why selling options is also a very good strategy, because I understand it could look bad when you first glance at it and see the ROI very little, but once you understand the logistics of success rate, probability of profit, you understand why this on the long term it is a very good and winning strategy. So this was the first video, and again, I want to see your comments down below to understand what else we can talk about, what else I can try to teach you, and what else we can learn together here regarding options. So I want to see you guys chatting down in the comments, and you can also find me there. So leave a question if you have any. And as always, before we end, just scroll down a tiny bit and like, subscribe, and turn on notifications so you don't miss these next videos. I hope this was insightful. Maybe these next videos they're going to see next week are going to be a little different because I'm going to be traveling, but don't worry, we will be seeing each other in this studio once again. Thank you so much, and I'll catch you guys in the next one. Peace out.